Hello and welcome to this introductory overview of AutoChartist's key levels. We've already discussed the concept of support and resistance in the video on chart patterns. We've seen that these levels form where the shared views of market participants are that price should go no higher or no lower than a certain level. With key levels there are a couple more characteristics that makes them particularly interesting. Key levels are nothing more than horizontal support or resistance. This means that the peaks or troughs of the price graph line up to a horizontal psychological barrier. You may note that a horizontal line on a historical price graph is a singular price level. With dynamic support or resistance lines, that's ones that slope up or down, the market participants adapt their decision points linearly as time goes by, so the price point at which they would buy or sell goes proportionally higher or lower with time. But with key levels, that price level stays the same throughout. Now let's investigate what could be some of the reasons behind the formation of such key price levels. In other words, we ask, why do traders find certain price points significant? The most common or obvious case we encounter around significant or whole numbers. The way people's cognitive processes work when it comes to numbers is that we tend to look for edges or rounded numbers, rather than the arbitrary decimals that fill up the gaps in between. For example, 1.5 is halfway between 1 and 2. This has been a significant resistance level for the Euro-USD for many months in 2009 and 2010. When the US dollar and the Canadian dollar reach parity, in other words, when the exchange rate equals 1, it's also an important level of both support and resistance. More recently, we see a few additional examples. Gold at $1,700 an ounce, oil at $100 per barrel, and the S&P 500 finding resistance at around 1,400 points. Another potential reason that can make a price level significant is when there is some structural point in the market when the viability or profitability of some large-scale projects may change. We're talking about projects that can significantly change the pricing of currencies or commodities, so they have to be big. For example, there may be a point at which a certain market price of oil makes it economically feasible to start mining oil from sand fields or other more costly exploration techniques. That would effectively broaden the potential supply and thus halt the increase in price. A third explanation for the establishment of key price levels is historical maxima or minima. This can happen on various timescales, for example the maximum for the week, the month, the year, or in the past 100 years. For some reason, when the price approaches an all-time high, there tends to be some hesitation that results in a resistance level. Two examples here are Oracle, that peaked in the boom at the start of the millennium, and IBM, that had these resistance plateaus at various points in its history. There could also be political or economic factors that play a role. For example, when a government such as Switzerland decides that it will intervene when its currency strengthens beyond a certain point relative to other currencies, and they increase their foreign reserves and thus increasing the international supply of their currency, they can create a key level of resistance. These are a few reasons why we can find support and resistance at specific price levels. The base criteria for AutoChartist to identify a key level is that there be a minimum of 3 touching points at a specific price level within a small error margin. Key levels can have more touching points, up to 10, and the more touching points a key level has, the more significant the level turns out to be. It is how the theory of support and resistance goes. But it also makes logical sense. Every time that a level is tested or touched but not broken, it is another case in point whereby the market confirms that it is not prepared to go higher than that price. The more often it happens, the more likely it seems that it will happen again. So once a key level has been identified and we can see how significant it is, there are 2 possible types of trade opportunities that arise. The first is a breakout. When a key level is breached, the theory is that the momentum of the price will carry it some distance beyond the identified level. A breakout is identified when there is a definitive breach of the key level, and it is presented together with a target level where one can expect the price to move towards. Another type of trade opportunity is when the price has bounced off a key level and moved away, but it is now yet again approaching that level. Here, the expectation is for the price to reach the key level once again. A secondary opportunity exists that the price would continue beyond the support or resistance line, forming a breakout. As you can imagine, horizontal support and resistance not only provide potential trade opportunities, but they also give traders some very good indications of where to place stop loss and take profit levels. What's more is that they can be powerful confirmations of other opportunities. For example, certain chart patterns have horizontal support and resistance built in, like ascending or descending triangles, rectangles, head and shoulders. So if one were to look at all the action that happens at or near a price level, it may provide an even deeper level of insight and more credibility to each pattern involved than if they were evaluated individually. Take, for example, this descending triangle on the Australian-New Zealand dollar exchange rate. Its support level is relatively close to a much larger horizontal support level that confirms it, and an even larger scale support level. So you have confirmation on various time frames by different pattern types. Here's another great example where you find an ascending triangle that is confirmed by a greater resistance level on the GBP CAD currency pair. Although our key levels have a very high accuracy rate, most often more than 70% of the time reaching their targets, we still advise you to trade with extreme caution and to use this type of analysis together with other research, such as news, the opinions of other analysts, and other forms of technical or fundamental analysis. For more information on other types of analysis, you can also watch the videos on chart patterns and Fibonacci patterns. You will find these in the same place that you found this one. Best of luck with your trading, and thanks for watching this video.